What if I told you the secret to protecting your wealth and paying less in taxes is to own nothing but control everything? Sounds kind of crazy, right? But it's exactly what the wealthiest people do. John D. Rockefeller, one of the richest men to ever live, once said this principle was actually the key to his success. And in today's video, I'm going to break down why many millionaires, even billionaires, follow this strategy. And I'm going to share the three main reasons they do it. And trust me, the third one could save you a fortune. Let's dive in. Number one is this: liability protection. So I want you to imagine this. You've worked hard, you've built up, let's say, $4 million net worth. You're in your 50s and you're starting to slow down. But then something unexpected happens. Maybe you get into a car accident, or maybe somebody slips and falls at your house during a Christmas party. Maybe they were overserved, I don't know. And then they decide to sue you. Now, your regular insurance, like auto or homeowner's insurance, will cover some of the costs. But what happens if the lawsuit is actually for more than your policy covers? That's where this type of insurance kicks in. Umbrella insurance. Umbrella insurance, think of it, it's like an extra layer of protection, sort of like an umbrella, that kicks in when your standard insurance maxes out. So for example, let's say your homeowner's insurance covers $500,000 and you get sued for $1.5 million. An umbrella policy would step in to cover the remaining $1 million. It's really like a peace of mind for those worst case scenarios. But here's the catch. Even with umbrella insurance, like most insurances, if you ever dealt with them like I have, there's no 100% guarantee. Sometimes lawsuits can actually exceed that extra coverage, or your insurance company could deny the claim altogether. That's why asset protection strategies like using LLCs or trusts are so critical. They add another layer of protection for everything that you've worked so hard to build. In the Bible, it actually states, too much is given, much is required. Too much is given, much is required. So think about it. Most of us go through our entire careers accumulating or trying to accumulate a lot of money, and we never really think about losing it. We're always going to work. We're always trying to do this, do that, get into this investment, all of these kind of things, making money, and never thinking about what happens if it potentially all went away just like that. Too much is given, much is required. The rich understand that keeping their wealth requires protection, and they routinely safeguard their assets, again, by holding them inside entities like LLCs or trusts. So for example, if you have a rental property or equipment and it's owned by an LLC, it's actually going to separate out your personal assets, kind of like your savings and your home, from a liability. So if something goes wrong, they can't come after everything that you've worked hard for. That's number one. Number two is why millionaires don't own anything they control. They like to keep things confidential. Not everybody, even though you may not think this, but not everybody wants the world to know what they own. Even though you look on social media or something like that, you think that everybody wants everybody to know where they're traveling, or they have this car, this boat, this house, or whatever. Not everybody likes that, or not everybody wants that, whether it's for privacy, safety, or just keeping a low profile. As you know, visibility can sometimes bring unwanted attention, and the more assets you have in your name, the bigger target you can become. Here's the good news. Again, holding your assets in structures like LLCs, trusts, or corporations make it that much harder for people to figure out what you own. These legal entities actually act as a shield around your assets, removing your name from public records and replacing it with the name of whatever entity that you come up with. Here's an example. Let's say that you own 3 rental properties. Now, if they're all held in your personal name, well, anybody can go on the internet, do a quick search, and actually connect those properties directly to you. But if you place each property under a separate LLC, like Beechwood Rentals, Sunset Holdings, LLC, something like that, it becomes much harder for somebody to link those properties back to you. Why does this matter? It's because of this. We want to make sure that we're going through life and doing the best that we can, avoiding lawsuits. Okay, we talked about that for number one, avoiding lawsuits. People are less likely to sue you if they think there's really nothing to go after. If your name doesn't show up as the direct owner of valuable assets, you're far less of a target. Here's the other thing. Not everybody needs to know what you own, remember? Whether it's your nosy neighbors, business competitors, curious parties, holding assets through entities keeps your wealth more private. Think of confidentiality strategies as a way to keep your personal and financial life off the radar while still fully controlling your wealth. The goal isn't to hide, so to speak, it's really to protect. And for those of us who've worked hard to build something, privacy is really a luxury worth prioritizing. If you combine this strategy with proper insurance and asset protection structures, like we covered earlier, you're actually giving yourself multiple layers of defense. Remember, it's not about secrecy, it's about smart planning. Leading us to number 3, and one of my favorite, it's this, tax advantages. Now, here's where things get really exciting, okay? If you're a high income earner, which if you're watching this, more than likely that you are. And if you are a high income earner, you're likely already feeling the squeeze of high personal income tax rates, okay? In the US, as of this recording, the top marginal tax bracket can actually go as high as 37%. But do you know, or did you know, that corporations are actually taxed differently? The federal corporate tax rate is a flat 21%, which means if you actually structure your investments or businesses correctly, you could actually save tens of thousands of dollars in taxes each year. Let's go through an example. Let's say you actually run a successful dental practice and you've also invested in some RV parks for passive income. Now, if you own the RV park personally, any income it generates flows through to your personal tax return, where it's actually taxed at your marginal rate. That could mean anywhere from 35 to 37%. Now let's look at the alternative. What if you held your RV park under a corporation? Remember, we talked about an LLC, and this could be either an S or a C Corp. I'm a dentist. I'm not a financial advisor. I'm not an accountant. Don't take this as financial or tax advice. Check with yours. I'm just simply giving you examples to think about money and how to protect your money, okay? Now, if you have your park and you held it in an LLC, again, like an LLC that's taxed as an S Corp or C Corp. So instead of your income being taxed at your high personal rate, it could be taxed at a much lower corporate rate. All right, here's the math. So let's say that your RV park generates around $100,000 of revenue, $100,000 of profit each year. If you're taxed at 37% at your personal tax rate, you're going to be paying $37,000. At the corporate rate up here, you're going to be paying lower $21,000. Right there, that's already a $16,000 savings in 1 year. But here's actually where it gets better. Thanks to something called depreciation, and I don't want to go off on too much of a tangent here, but depreciation and then even better, bonus depreciation, you may be able to reduce these taxes close to zero or very close to zero or zero itself. Real estate investments like RV parks, mobile home parks, they allow you to take advantage of depreciation, which actually is a way that the IRS allows you to deduct a portion of your property's value each year due to the wear and tear as a loss. Even though your property is going up in value, they still let you take a loss. Think about that. What other investment is there that's like that? It's unbelievable. Think about your vehicle. Well, you can depreciate your vehicle, but after 5 or 6 or 7 years, your vehicle's not worth as much as you paid for it, right? That typically doesn't happen for real estate. You buy a property, it typically goes up in value. You buy a car, it typically goes down in value. But the IRS still allows you to write off the depreciation, even though it's going up in value. And with bonus depreciation, you can actually accelerate these deductions, especially in the first year, to offset most, if not all, the taxable income. So in short, you're already saving money if you structure this with the corporate tax rate. Then depreciation can actually take that savings to another level by wiping out much, if not all, of your taxable income. This is why, pay attention here. Remember I talked to you about this number 3, the tax advantages? This is why so many wealthy people, and you actually Google it, so many wealthy people invest in real estate. It's not just about the tax flow. That's what most people get into it thinking, myself included, but it's about using other things, about using legal tax strategies to invest in something and keep more of your money versus going out and trading your time for money where you're taxed at the highest rate. Of course, again, this isn't a one-size-fits-all approach, okay? The right strategy depends on your specific situation, which again, why it's so critical to talk to your CPA or tax advisor. But This is exactly why so many high net worth individuals use corporations to hold their assets. They get to protect and grow their wealth while paying less in taxes. Okay. Now, as you remember, I mentioned a good bit about using depreciation to avoid paying taxes when you invest in real estate. Do me a favor, check out this next video if you want to learn more about how to use it.